Green shoots are growing. There are early indications that inflation may not carry on as much as it is right now for as long as people expect. This is very important because everyone expects interest rates to go to the moon and back. But if this data is true, these 6 charts that I'm going to share with you in this video, then inflation is not going to go to those heights. Interest rates are not going to go to those heights. And therefore, property prices are not going to be as impacted. If you want to be ahead of the curve in your economic understanding of the global economy, the local economy, and therefore house prices, then carry on watching. My name is PK and I help people build passive income through the Property Investment Accelerator using data without, dropping 15K on a buyer's agent every single time. And this channel exists to discuss property investing, the economy, and financial happiness. Subscribe now. Let's go. So I promised you 6 charts. This is the first one. West Texas Intermediate WTI crude oil price. There's 2 ways of pricing oil. One is Brent and the other one is WTI. What you can see here, really interesting, right? In the middle of COVID, right at the start of COVID, do you remember back when, oil prices were actually zero? Actually, technically, they went under zero. It was very interesting. And since that time, they have steadily increased with more government stimulus, fiscal policy, etc., etc. What you can see for the first time in the last couple of months is that this oil price is starting to go gradually down. It's starting to level off. Now, you don't see this at the pump right now, and you won't see this at the pump for probably the next 6 months. But if this trend continues, then we're seeing that rate of inflation is going to be severely impacted in a positive way, because oil and transport costs contribute an incredible amount to inflation. The second chart is soft commodity prices. Okay, this is like wheat, this is corn, this is soybeans, this is oats. Ingredients, raw ingredients that power, you could say, humanity, but basically are used in most processed foods. And let's be honest, most of us eat mostly processed food globally. So this is the chart 2018 to present, and you can see that all of this, oat prices, soybean prices, everything has been rocketing through the roof. Just notice in the last 1 or 2 months it's starting to trend down, especially wheat. Wheat went up so much because of Ukraine crisis, that Ukraine produces a lot of wheat. The transport hubs were blocked, but finally that is coming down a little bit. The third chart is fertilizer input commodities. You might be wondering, why is fertilizer important? Like, I don't do that much gardening. Well, fertilizer obviously is a key input to a lot of the world's, or most of the world's, food production. We need soil, we need water, we need the sun. Soil needs fertilizer. And that Middle East spot urea price and there are 2 key ingredients to fertilizer. One is the Middle East spot urea price, and the second is the US Tampa, I'm not going to pronounce that, ammonia spot price, I think it's called. Both of them have just started to trend downwards. This blue line, the ammonia, is coming down, and so is the Middle East spot price. So once again, this hasn't really, especially with this ammonia one, it hasn't really happened for forever, since 2018, right? So this bodes well. You won't see it immediately transpiring into, prices at the shops, but this is starting to redirect that ship. That ship takes a long time to redirect. It's heavy, it's got a big load, but just things are starting to shift. And I want you to understand this data. It's not my opinion. Automotive supply chain indicators. I really like this semiconductor prices chart. All right, semiconductor prices, this is the reason why brand new cars are so much more expensive right now, because semiconductors, everyone knows, is a key input to making new cars. There's huge bottlenecks, supply issues, etc. And therefore, new cars are more expensive. People have to buy old cars. Those become more expensive, etc., etc., etc. For the first time in a long time, these prices have started to come down, in 2022. So once again, you might be thinking, hey, when I go on carsales.com.au, free plug, or, to my BMW dealership or Toyota dealership or whatever, I don't drive either of those 2 cars, I don't see prices coming down. It will take time, but these are some early green shoots. The fourth, I think fifth chart actually, is the Drury, maybe that's how you pronounce it, WCI Composite Container Freight Rate. This is the US dollar per 40-foot box or 40-foot container. What does this mean? When there is a huge demand for consumer products, let's say out of Shanghai, outside of China, this rate goes up, just like it did at the start of COVID. Everyone's locked down, they're going on Amazon, they're going on eBay, buying a whole bunch of stuff because the government's giving them money, free money in a lot of instances. They had nothing else to do, no one's traveling, they got all this disposable income. They're gonna splash it on stuff that, let's be honest, most of us don't need. The second thing that raises this price is bottlenecks. When there's huge bottlenecks, the price goes up because there's not much supply. There's more demand, so therefore prices go up. For the first time, actually this has been happening for about 4 or 5 months, but you can see that prices are starting to come down. Those bottlenecks are easing because monetary policy is tightening, which is the intention of the central banks globally. That is resulting in consumer spending not increasing so much and consumer sentiment shallowing out, softening. Therefore, this very key indicator of global inflation is coming down. Early shoots. And the last one is hard commodity prices. Everyone knows globally and locally in Australia how expensive it is to build a house. I think prices have gone up 40% to build a house in the last 2 or 3 years, something like that. But after a long time, you can see, and once again, this doesn't mean that house prices or the construction costs, building costs of houses will come down in the next year. But what I'm trying to illustrate is things like lumber, copper, steel, iron ore, the raw ingredient costs have started to come down. You can see this in the chart, and it's not my opinion, but what is my thought is that this is how inflation works. These 6 charts are the 6 key ingredients to global inflation. And what this is really useful for is, I want you to understand this, right? Stick with me. When inflation rises, let's say something costs $100 before, now it costs $110. That's 10% inflation. Everyone freaks out. The next year, that thing costs $112, it's still gone up by $2 year on year. It's still more expensive than what it was the previous years, when it was back at $100, but the rate of inflation has shallowed out. That thing is still more expensive, so you can still complain, gas prices used to be this, but that rate of inflation has shallowed out. It went from 100 to 110, everyone went berserk, 10% inflation. Then from 110 to 112, that's less than 2%, So what does that tell us? Even though prices are going to remain at elevated levels, they're not coming down, they're going to be way more than pre-COVID levels, the rate of inflation has already baked in that initial exponential jump, and the rate of inflation is now going to taper down. These are my thoughts by some early indicators. Now, of course, these indicators can swing around the opposite direction, but with quantitative tightening going on, and that is the reason central banks quantitatively tighten. That's the reason they lift interest rates, to cause pain. So if you're feeling pain at the gas pump, I don't know why I'm calling it the gas pump, I live in Australia, at the petrol station or the servo, at the, Woolies, Coles, or, whatever field you're experiencing pain, that is exactly what you are intended to feel by the central bank. Because if you don't feel pain, you're just going to pay more and more for stuff, and inflation is going to go higher and higher. So inflation, the large majority of it, from the US, we're hearing figures like 8%, 9%, Governor Lowe is spitting out figures like 6, 7, 8%. These are happening right now, but these are being baked in to future rolling average, 12-month average figures of inflation. Inflation is probably going to go up a little bit because all these indicators I shared with you are leading indicators. Inflation is a lagging number recognized or calculated every 3 months, every quarter. So inflation is not going to come down just because I did this video, right? But in 12 months' time, inflation is not going to be what we think it will be if these leading indicators are correct. Keep that in mind. You heard it here first. Keep that in mind. There's a very intelligent investor, I forget his name. What he said was, don't invest based on today's prices. Picture the world in 18 months and invest based on those prices. And if you think the world will be better in 18 months, then those prices will go up regardless of what commodity you're investing in. But I can't tell the future. I do have a picture for the future. Tell me, what is your future? Do you think inflation will continue to go up and up and up for the next 2, 3, 4 years? Or do you think it will start to shallow down? Leave that in the comments below. I'm always grateful for you, my community. Give this video a thumbs up. And if you're new, hit the subscribe button. Always remember, I just always want to say, before you invest in anything, invest in yourself, because the 6 inches between your ears are the most valuable real estate you will ever own. Okay, knowledge is power, and your power is in the present. So level up. I'll leave links below to my Facebook group with more than 20,000 investors, and my podcast on Spotify, Apple Podcasts, Google Podcasts in the comments below. My name's PK, and you can do this.